Welcome back. We still have Benay and Kedilatile in studio with us. So we were talking about, debt counseling and understanding what it means and what the process is. However, there's a lot that happens before one is in debt. You don't just wake up and suddenly you find yourself in the situation. There are things that, one can access overdrafts, credit cards, and all kinds of immediate access loans. And some of them have their place, they can do good, but there's that part where it goes a little bit over and you push the envelope and it turns out into a situation where things can go bad. Let's talk about these forms of credit that one can get access to. How do you know when it's good debt and when it's bad debt? Let's start off with you.
Yeah, I think in terms of how consumers find themselves in the debt situation, I think there are two distinct reasons. One is, like you described, kind of overextending due to a number of reasons. And the second one is something unexpected happens to the consumer. And we're finding more and more of that being prevalent in today. Now, in terms of the types of debt, there's what we would normally classify as good debt is money. When you borrow money, you can use it for building equity in something that will have a value in the future that's more than the value today. So a house would be a typical example of this. Investing in your education, getting a degree, or going to tertiary school or vocational school would be another one. And anything else that you can think of that you can add value. Things that are not necessarily good debt, but probably people need, is something like a vehicle finance. Most of us do need a vehicle to travel to work. So in a way that it helps us get to work and earn an income, it's also, I would say, more of a good debt, so to speak. Now, things that we would say is not good debt probably is things related to sort of today's consumption. So it's necessary, but things overspending on, let's say, holidays or luxury items or store cards or things like that, things that don't allow you to build some sort of equity that you can use in the future. That's what we would call normally as bad debt.
Is there a fine line between building a good credit score and a credit score that can turn really badly, like from your perspective?
Yeah, look, there is a fine line. Credit is there for a reason, and there's absolutely nothing wrong with credit. But the problem becomes if we place reliance on credit. Remember, whatever you borrow from a credit provider or whatever you use from a credit card or overdraft that has been granted, you will have to repay at the end of the month or periodically. And when you repay, you have to pay with interest. So the problem becomes when we rely on credit, so even on essential expenses. So credit becomes a way of life. We buy food, with credit. When you start paying debts using credit as well, you delay in the inevitable. At the end, you'll end up having no option because even the credit cards and the overdraft, you will max the limit that has been provided. So there is a fine line. The minute we place reliance on credit, that's where there is a problem. And we are saying, as the regulator, there are indicators. Benay has mentioned some of the indicators. And of course, there are circumstances that can lead one to finding themselves in a distressed financial position. Hence, the Act has provided debt counseling as a debt relief measure to say, instead of borrowing more money to pay off debts, there is a mechanism in place where you can make reduced payments to get the rehabilitation required.
What happens in situations where the mechanism is in place, you are under debt counseling, and something unfortunate happens and you are retrenched from work? What is the process from there? Benay?
Normally what we would do is we would work with the consumer when they inform us. And the first thing we would look at is to see whether they have some of the insurances that might help pay for their debt. So often what you will find is many consumers, most of the credit agreements do provide for what's known as credit insurance or credit life insurance that consumers are already paying for. And in most cases, that would cover up to 10, sometimes even 12 months of debt repayments back to the creditors. So for immediate relief in debt counseling to be able to continue if there's a retrenchment, in most cases, consumers who have this are able to activate it and cover their debt. However, it doesn't cover their income in terms of putting food on the table and all of that. And for that, I think we advise them to work with people close to them, family members and others who might lend them some money to help bridge over. And of course, there's also the unemployment insurance fund that might help them. If they have been making the contributions or their employer, they can usually claim for a few months that will help them.
Speaking of employer, I mean, we were talking about how debt counseling has become stigmatized and not a lot of people will talk openly about it with friends or family. How important is it for one to be honest with their employer once they are on debt counseling? Should you be that forthcoming?
Look, there is nothing that puts an obligation on you as an employee to inform your employer. However, it is advisable because some employers would have wellness arrangements with certain companies where you can actually go and get help. But there's nothing that places that obligation. In terms of the Act, however, if you are in a position where you have to deal with financials, it becomes an obligation because you will have to display the ability to be able to manage your own finances. So that is the only provision in the Act where an employer can actually go and check your credit record.
Benay, your thoughts?
I agree. I think it's advisable to let people know because it does appear on the credit bureau as you have entered debt review. And there's also what we find is for most consumers, because of generally the stigma attached, there are many more like them who are actually working in the same workplace, who are under debt counseling. And what we find is the biggest support is for them to seek out other people in the same work situations and almost form like user groups and support groups. We find that consumers benefit hugely through this process, and there's a lot of learnings that are shared. So that's also another reason to let your employer know.
Earlier on, Benay was talking about approaching your friendly debt counselor. How does one know which debt counselor is for them and whether this is the right process with them?
So for one to operate as a debt counselor, they have to be registered with the National Credit Regulator after having satisfied certain requirements. So there is a course that you will have to do and pass and get a certificate. And we've been mentioning about being able to conduct your own affairs, accordingly as a debt counselor. So those are the requirements that they will have to fulfill. And upon registration, we issue them with a registration certificate that has a validity period. It's usually valid for a year, as every year debt counselors have to pay the renewal fee. So that's one thing that a consumer can use to identify whether it's a legit debt counselor. And we also give them what we call a window decal, which has NCR logo on it. That's what they use to place on their place of practice. So that's the mechanisms that consumers can actually use to identify that they've been assisted by someone who is legally registered.
All right, Benay, 5 or maybe a couple of common debt traps that you've seen over the years and how one can avoid them.
So first is probably not budgeting. Understand your real budget. And what I mean is write down every single item that you spend money on, whether it's on credit card or cash or anything else. That's one. 2, check your insurances and your assurances. If you can provide, make sure you have your short-term insurance, your medical aid in place, if you can afford them, at least some sort of protection for the inevitable. The third one is probably don't underestimate your own, willingness to be convinced to spend money when you least expect it. The fourth one is, in terms of a debt trap, actually talk to your family about debt. What we don't see often is, talking to your kids and your family about debt and explain them what it actually means to debt. As Kedi said earlier, debt is not necessarily a bad thing. It's when it reaches a level that becomes a burden that's a bad thing. And number 5 is talk about interest. Talk about interest, what it actually means, how it works, compounded interest. Write down the mathematical formula for yourself, for your kids. Understand that compounded interest could be a beautiful thing if you use it to your benefit, but it could be an awful thing if you use it to your detriment, if you miss your payments.
Anything to add?
Understand what you're getting yourself into. As a consumer, in terms of the National Credit Act, you have a right to be given an opportunity to think about it. If something is being sold to you, ask for a quotation, go home, sleep on it, and ask yourself whether you need it or you want it. If it's a need, perhaps you can consider, but if it's just a want, you can actually save up for it and avoid wanting to keep up with the Kumalos because we are not the same.
All right, let's leave it there. Thank you so much. Those are my guests for tonight. Thank you to Benay Sager, who is the Chief Operating Officer at DebtBusters, and Kedilatile Legodi, who's the National Credit Regulator's Debt Counselling Manager. Don't forget to tune in next time when we discuss financial tips for women. And remember to share your thoughts and insights with us by tweeting at Business Day TV using the hashtag SmartMoney412.